The July CPI just dropped and inflation held steady overall, but the details within the report tell a much deeper story. Tariffs are beginning to leave their mark. The Fed is still split on whether or not they want to cut rates. Small business optimism is climbing, and U.S. customs revenue is at record highs. Today we're going to break this down layer by layer, not just what the numbers are, but what they mean for the economy over the months ahead. Let's get into it. So CPI, which was for the month of July, and let's talk about what CPI is real quick. So it stands for Consumer Price Index, and it measures the average change over time in prices paid by consumers for both goods and services. It's one of the primary gauges for the Federal Reserve and what they watch for when deciding their interest rates and monetary policy. Measures inflation. So for July, what we got is year over year, the headline number came in at 2.7%, unchanged from June, but that was slightly lower from the 2.8% that economists were forecasting. Overall, the month over month was up 0.2%, so that was right in line with expectations. Core year over year increased by 3.1%, so that was slightly above the 3% forecast that a lot of people were watching for. Core month over month was 0.3%, which is the largest gain in 6 months. But a lot of people were expecting inflation readings to start coming in a little bit higher through the summer months. July's in the summer due to the Trump administration's tariffs. Now, core CPI excludes food and energy because they tend to be volatile month to month. And from the Fed's point of view, they watch this more closely because it's considered a better indicator of long-term inflation trends. Even though when you think about it as a consumer like you and I, food and gas is where all of our money tends to go. So, kind of weird. Now, where are we seeing most of the price increases? Just for starters, energy prices declined. Grocery prices were flat, and rent growth, one of the biggest inflation drivers over the past 2 years where inflation's really proven to be sticky, has slowed to just 3.7% year over year, which is down from 5% just a year ago. And that's pretty notable because shelter costs make up roughly 1/3 of the entire CPI basket, but elsewhere tariffs are starting to show up. We've seen furniture increase 0.9%. Tires up an entire percent. And I've seen this because I had to buy all 4 new tires. And when I looked at the price, like my eyes are popping out of my head on what they hit me for. Pet products are up 0.5%. So these categories are more exposed to import costs. And economists like Alan Duttmeister at UBS, sorry if I said your last name wrong, say this is a clear sign that tariffs are passing through to consumers. And historically, tariff impacts often start small, but they tend to grow over time as supply chains begin to adjust and companies run through old inventory, thus needing to replace inventory. That's why the muted inflation in goods this month, which was up 0.2%, might not last very long. And we could see more pressure in the fall as time progresses and we get more readings. Now, goods prices, and especially those excluding food and energy, actually rose only modestly in July. And that's a relief because these are the categories most directly affected by tariffs. And the bigger problem here is that services inflation, it jumped 0.4% month over month, which was the biggest increase in 6 months, including the housing, Medicare, medical care, transportation, and other non-physical services. And historically, services inflation is stickier than goods inflation. And what stickier means is when something's sticky, it sticks around a little bit longer. So, and that's because it's tied to wages, contracts, and long-term cost structures. And the last time services inflation was this high was for a sustained period was in the late 1970s, and that period required aggressive Fed action to bring it back down, which is where interest rates, around the time where interest rates went really parabolic, and they had to bring inflation down through means of raising those interest rates pretty high, higher than the rate of inflation at that period in time. Now let's talk about the Federal Reserve's dilemma, because we got two different parties here, because we know some of the Federal Reserve members, FOMC members, want to cut rates. We know some don't. And the Federal Reserve has what's called a dual mandate. They want to keep inflation around this 2% target for whatever reason. The 2% is what they picked. And then on the other side of the teeter-totter or the scale, whatever you want to refer to it as, maintain maximum sustainable employment. So they want to watch the job market and they want to watch inflation mainly around that 2% target. Normally, rising core inflation would argue against rate cuts, but unemployment has been ticking up from 3.5% just a few years ago to around 4.2% right now. On top of that, AI development and investments into AI, while businesses are hiring a lot less than they have in the past. And this is where the Fed's very split. What we've seen today is that Kansas City Fed President Jeff Schmid, he revealed that he doesn't really support any cutting of rates right now, so there's no need to cut rates. Inflation is manageable, and the labor market is still healthy from his point of view. Then Richmond Fed President Tom Barkin, also not calling for any cuts yet, but is open to adjusting policy if things worsen. But remember, the Fed decisions are heavily influenced by the balance between inflation risk and the job market weakness. So if the Fed judges unemployment as a bigger threat than that of inflation, they could cut even if inflation is well above their target. Historically, this has happened in 1995. For example, the Fed cut rates even though inflation was rising because they feared slowing growth was more of a concern than inflation being above their target. Now, we also got a reading from this small business optimism. And the NFIB, the Small Business Optimism Index, rose to 100.3 in July, which is up from 98.6 back in June. And this is above its longer-term average of 98. Now, why this matters is because small businesses make up nearly half of private sector employment in the U.S., so their sentiment is a leading indicator of investment, hiring, wage trends, and there are some key drivers here. So improved business conditions, more willingness to invest in expansion, easing uncertainty due to trade deals, including that with the European Union and Japan. Some are still getting delayed, like China, for example. Haven't got nothing for Canada yet. And then this isn't necessarily I guess Russia still counts as a trade deal, which we haven't got that yet. But there are challenges that remain. Labor quality remains the top concern for a lot of them. Some firms report weaker sales as being a problem of concern. And then uncertainty about long-term trade and tax policy as to where we could go. Historically, a sharp rise in small business optimism can precede a boost in hiring and capital spending, but only if credit conditions remain supportive. Now, this is where we get in to talk about these customs. So the U.S. collected $28 billion in custom duties in July, which is up $1.3 billion from June, and $135.7 billion since October. So the money's definitely pouring in, and that's more than double the last year's pace. A third of that revenue came from imports from China, and $22.1 billion came from reciprocal tariffs on goods from most countries. Now, why this matters is because while tariffs bring in revenue, they also tend to raise prices on imported goods, either through direct means, through the duties themselves, or indirectly as domestic producers raise prices because their costs went up. Goldman Sachs projects that by October, 2/3 of the tariff costs will fall on consumers for consumers to pay up. And in a way, that's another sign of inflation. And a lot of people are wondering if we go back to this consumer price index, the CPI data, economists, Fed members, everybody's split as to whether or not CPI and inflation, PCE, PPI, all of these inflation gauges, whether or not tariffs are just a one-off increase and then we just go back to normal, or if these tariffs prove to be sticky and lead to higher inflation averages over time. Now, historically, let's talk about tariffs, because historically tariffs have been mixed results as far as what we've seen. So back in the 1930s, the Smoot-Hawley tariff Act contributed to a collapse in global trade during the Great Depression. Some argue that the tariffs in the 1930s are what sparked the Great Depression. But in the 1970s and early 80s, targeted tariffs and quotas were used to protect industries, but also contributed to inflation. Today, the difference is that the U.S. economy is more service-driven and global supply chains are more integrated than they were, meaning tariff effects can be delayed but still significant when they're hit. So this is where the market implications come in. So for markets, here's what's to watch. If this goods inflation remains muted but services inflation stays elevated, the Fed might lean toward cutting rates to protect the job market, which is bullish for stocks at least in the short term. But if tariffs pass through and accelerates and CPI jumps in the fall, and CPI plays into what the PCE is, which the Fed's preferred gauge of inflation is the PCE, personal consumption expenditures, potentially this is going to be viewed as bearish because the Fed could hold rates steady for longer, so higher for longer, as far as what they're going to do with the rates. And this could be seen as bearish for rate sensitive sectors like real estate. And I'm a real estate agent here in Oklahoma City. Overall, we're holding up pretty well because people just see and they come here and they're like, man, why haven't I heard of this place yet? So they're coming from like California. A lot of people I meet are coming from California, a couple from New York, Florida, Texas, and they're just finding out it's such a gem here. So that's what's to watch out for. Small business optimism, if sustained, could boost cyclical stocks and support the broader market rally. But overall, July's CPI shows inflation holding steady, but the composition is beginning to shift. Tariffs are starting to sweep into the prices, services inflation is climbing, and the Fed is facing one of the toughest trade-offs in years. Do they pick inflation or do they pick the job market? So for investors, this is a data-dependent moment. The next CPI and jobs report in early September could determine whether we get a rate cut in 2025 or if we're just sitting tight for a longer pause. So if you want to stay ahead of these shifts with deep analysis, hit the subscribe button, drop a comment with your take on whether the Fed should cut rates in September, and I'll see you in the next video.